Market is in total fear mode. The VIX is at a 52-week high. All the stocks are down. I think 80% of the stocks are down, hitting 52-week lows or all-time lows. So let's look into the data. Let's look at what is causing so much fear out in the market there. Is it all justified? What should you be doing as an investor? What should you be, analyzing, or what should you be looking at? And when you look at companies, what can you actually influence? That's the question, right? You have macro factors and you have your companies that you want to invest in. So we're going to look at what you can actually influence as an investor and what you should be doing in a situation like this where there's so much fear out there. So let's get straight into it. But if you haven't subscribed yet, it's just one click away. Please give me the like and the subscribe, and let's keep going. So what we have in the market here, obviously the VIX is at a 52-week high. So it hasn't been that high since, if we scroll out a little bit, this peak here was basically in the times of Corona. Now we're pretty up there. It's not like that, but obviously that was a 20 to 30% drop. We're up there in the last few days, few weeks, when we had the news around interest rates. That was around here. Then we had news around the Ukrainian-Russian war, obviously, which caused the first spike here, and today another one. So we just have all these topics right now at the moment that causing the VIX, which is the volatility index, to spike. And what volatility basically means in the market is that more people are selling and buying. And as soon as there's more trading going on, volatility is going up. So basically there's a lot of people now selling on a daily basis because of those news, because of what's happening in the market. And that translates into the so-called fear and greed index. So if you look at that, it's something that CNN Business always releases. They're analyzing the data such as the volatility index, but also other things that gets them to a so-called fear and greed index. So is the market actually fearful or is the market greedy? That's what you want to know. Because in a greedy market, when everything goes up and everyone keeps entering the market, that's obviously something where you want to be careful at. Warren Buffett has taught us, be fearful when others are greedy and be greedy when others are fearful. So now we're in the extreme fear mode here. As you can see, we have an 18 out of 100. So we're pretty much down there, closer to zero. We're in that deep red territory where it's extreme fear in the market. That's obviously reflected in the stock prices as well. But yeah, basically means that extreme fear, every sort of news, people are very sensitive to the news, to the macro news that are out there, and they're selling very quickly because they're fearful of the uncertain nature that is happening, at the moment. And if you can, this is a sort of a nice barometer to see where is the overall market. So if you want to know on a daily basis, is the market overhyped? If the market has been going up, let's say 2 to 3% for a week or so every day, then you want to check this barometer to see where are we at. Are we still having room to grow here if you're around the 50-60 level? Or should you be careful if you're in an extreme greed mode? That means that prices are already pushed to the highs. And on the opposite, what we have right now, obviously you can also check that. So if you have stock prices been going down and down and down, you can check this barometer here to see, well, are we like at a close to zero here? Are we extreme fear levels? Have we reached that level yet? Or do we still have room to further go down? And based on this, we still have room to go down further on new negative news. Whenever there's something that is kind of surprising to the market, that's when you get these huge volatility spikes, when people start selling, because people or the market don't like these surprises. So if you have suddenly a war going on, people are thinking about all these different options that could happen and that what that means for their money. And that's when they are very quick to sell, obviously. So we have a situation like this going on right now, where we have this uncertainty. We had interest rates first, and then now we have the Russian-Ukrainian situation, which was completely unexpected for a lot of people. So that's adding a war to other issues that are already existed in the market, which is obviously not a great situation. And that's why we see the fear and greed index at a very low and the volatility index high, because there's just a lot of activity right now, a lot of fear in the market, and people start selling. And if you look at the stock market, if you look at CNN Business Market News, there's really nothing good at the moment. I mean, we have basically three big things that are in the room that are still causing investors to panic sell, to freak out, to be fearful. And that's obviously COVID. We still have it ongoing, and people are still a little bit uncertain about, is there a new variant coming out? Is this the end of the pandemic or not? Like, what's the future looking like? People are still fearful about what COVID actually, in terms of what the impact of COVID had on the economy as such. So that's one thing that we're still fearful about. Then obviously we'll still see, Russia and all the situation that's going on there with Ukraine. So we don't know, is this going to stop soon? Are they going to come to a conclusion, or is the war going on forever? And is Russia potentially, doing more, wanting to expand their territory even more into other countries? Like people or investors are all fearful about that because it's just such an uncertain environment. Not a lot of people have been dealing with a war when they were like investors. And so that is quite a new thing for them, and so we have to look into how this is further playing out. But obviously that's a huge factor right now that's adding up to that volatility or to that fear in the market. And then obviously you have the inflation that just doesn't keep dropping and keeps going up. We have oil prices a new all-time high, which are obviously affected by the Russian-Ukraine situation as well. But yeah, obviously you have inflation at a high, you have oil and other normal prices at a high, and then basically that adds to the fear that there are higher interest rates of the US and the Fed, that when they come out they have to raise interest rates even higher, bringing down valuations of especially high speculative tech and growth stocks. So that's the third point, and I think that's the most important point when it comes to the uncertainty stock, high spec stock, growth stock valuations, because that obviously has a direct impact on the valuations. The war as such is more an uncertain situation of what is the future going to bring. But I mean, if you're thinking that World War III is going to happen, then I don't think your portfolio is going to help you in any ways, and also your cash won't help you. So if you bet on that, I mean, I don't know what you're going to do then. You're probably going to just hide at home or something, because otherwise I'll just keep being invested, even though it's an uncertain situation. You don't know what the impact on the actual company that you invested in is going to be. If it's a US company and they're dealing with US, Europe mainly, then maybe it's not such a big impact as such. But obviously it still adds to the uncertainty that investors have at the moment. So that's why it's still a problem. So yeah, if you look at the market news, there's just negative news. And people are fearful and just don't want to invest. And I mean, I can understand it. But if you can see through all of this, and you can see through and look at your actual companies, I do think there's a lot of good deals at the moment. So today, again, we had another day where it would just keep dropping. We had some stocks with earnings coming out, like Intellia, and then dropping 20%. I mean, this market is just crazy. Like, those stocks were not even at an all-time high. I mean, Intellia, for instance, is a higher spec stock for the genomic space. But they were already beaten down like crazy, from the highs of $176 to $80, or before that was like around $100. So now they've on bad news or on bad earnings or not as good earnings as expected, this stock drops even further down 20%. So that seems to be just no bottom at the moment. So it's really hard to tell when you should be entering a position if you like one. I think you should just be slowly piling in. If you like a stock, then that's what you should be doing. But I can just see that across the board today we had a drop in, like, across the board really, like AMD, like microchips, Zoom came out with earnings, dropped on that, Snap, PayPal, Trade Desk, JPM, Facebook. So it doesn't really matter if it's a profitable stock, if it's a tech stock, bank stocks, like everything dropped today and went for a U-turn after yesterday. We had a bit of a recovery the last 2 days actually. So yeah, it has really just been going down and adding to the volatility right now. And obviously you want to know, like, should you be investing right now or not? I mean, you keep seeing things going down. So that if, let's say you had $5,000 and you put it in last week, there's a highly likelihood that you would be already down on your position 5 to 10%. And especially when you go into like a higher spec position like AC or Intelia or CRISPR or something like that, then obviously those are even, the volatility there is even higher, so they're falling even stronger. So the question is, when are you getting into these, right? Like if you look at this here, this is showing you the 52-week ranges. All of them are pretty much at a low that I'm tracking here, and they're not all just high tech and high growth stocks. Some of them are profitable and are good business models and have a lot of free cash flow. They're still all down. I mean, for instance, Corsair Gaming, there's no real reason why this should be trading at a 52-week low, given that the business is really working well, and there's no big disruption here for that. Sofi and TDOC, they've been showing impressive growth numbers, as well as Twilio here, and still the stock initially reacts positively to the news, going up anything from 5 to 20%, and then still dropping afterwards. So it really seems like whatever you do, if you buy before the earnings, after earnings, it just keeps dropping down. So I would suggest, in terms of investing right now in these types of stocks, you should be piling in at a slower pace. Build your position, have a position target, and build towards that target with bearing in mind that, let's say you put a $1,000 first into your stock, bearing in mind that it could drop, but it could also spike very easily. I mean, if there is a good day for something like a TDOC or Twilio, those go up 5 to 10% easily on a day. So you have to be happy with missing out on the potential 10% upwards move for the opportunity to maybe get it for even 10 to 50% lower if it drops again. So that's something to keep in mind. But if you look at the overall market, I mean, we talked about all the macro factors. We talked about all the fear that's all going out there at the moment. So the question is, what can you as an investor influence, right? And obviously, what we just talked about, you can influence in what companies you invest. So no matter what the market does, you have to look at your company. Is your company affected by any of this? Is your company doing well? What are the metrics? What are the business metrics? What are the financial metrics? What did the earnings say? What does management say about the company? And this is what you can impact, and this is what you can influence, because you can obviously choose to put your money in company A versus company B. Or you can just play the whole market if you don't feel comfortable with that at all. Because as we see here, this is a graph of the S&P 500, 400, and 600. And as you see, the 500 basically is the large caps, so the largest 500 companies. The mid caps is the S&P 400, and the small caps, so anything I think below 10 billion or so, is the S&P 600. And you can see here the forward price to earnings ratios. So the price to earnings ratio is obviously, the price of the stock right now divided by the earnings per share. And you can see that we're dropping down here substantially, pretty much the whole back end of 2021. We've been dropping down for small to mid caps, and now reaching levels as 14 and 13 for those, which we haven't seen for small caps down here, the green one. You haven't seen that one in 2011 and 12 and in 2003. And if you think about this is an index, so those numbers are obviously not that different. So if you look at an all-time high, for instance, it's only at 20 from a now 13, 14. So it's not like a huge difference. But for individual stocks, that can make a huge difference for their valuation, because this is obviously like an index of 400 big companies. So if you look at what would have happened if you had invested in the index in 2003, 2008, and 2011, and after that it's all been going up, 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 and now we're looking at another of these low valuations right now. The PE ratios are very, very low for small and mid caps. So meaning that if you invest in those, even if you just invest in the index, there's a highly likelihood that you're gonna reach a more median level in the future here, more like anything from 17 to 19 maybe, and that will mean that the valuations will go up, the value of your index investments will go up, and then if you choose some of those individual stocks that we've just talked about here, there's even a higher likelihood that those will go up even further, because what's really interesting for those ones, if you look at the small caps here, the green one, the price to sales ratio, because obviously if you don't generate any profit, the PE ratio is kind of a misleading indicator, because if you look at the PE ratio for a non-profitable company, obviously it's going to be low or even negative, because there is no price, there's no earnings, there's no positive earnings. So for those ones, look at the price to sales ratio. We have the same types of graphs here. You can see large cap still trading quite richly, although there was a correction here. It's still trading quite richly compared to in terms of a historical norm. But there's a different picture here for the small caps and the mid caps, which have corrected quite aggressively, now coming down to 1.3 for mid caps and to 1 for small caps. And 1 for small caps, if you think about it, these graphs should actually be, inverted. They should be the other way around. Small caps should be the one with the higher price to sales ratios, because those are the ones that are high. There's a higher likelihood that those ones will grow. So if you look at stocks like a HIMS trading at around, just below 2 price to sales ratio at the moment, those were up down here, right? And those are included in those small caps indexes, and those types of stocks are trading at a 1, where there's such a high growth rate going forward and such a high probability that those ones will grow a lot more going forward, so that actually you should be ready to pay anything from 1 to 10 price to sales ratio. And we can just see that when the whole index is trading at a 1, that there must be a lot of deals in there baked into this index that brings it down so much. So from a valuation perspective, we are at a really, really good time to actually buy into the market. And as you see, also when looking at Warren Buffett's core, we are at a very, very fearful market. So that adds just to the overall picture of, it all makes sense, right? The more fearful it is, the more people sell, bringing down valuation, making your investment, if you invest in those uncertain times where actually others are fearful, your potential investment returns are going up, because you're investing in something that's already so beaten down that there is a lot of upside potential and way more limited downside risk. So this is the situation we're in the moment. So what you can impact as an investor, what you can influence, is what companies are you choosing to invest at what valuation, obviously, and that's gonna matter. That's gonna impact your future returns, and you just have to kind of ignore that whole macro environment and just kind of pretend that everything is gonna be fine in the long run. And when you invest into the long run for 5 to 20 years ahead, then you shouldn't be caring about those news, because there will always be these types of news. In the next year, in 2023, the war might not be even an issue, but there might be something else that comes out, another crisis that is hitting the supply chain, and then companies can't send their packages around. So all these sorts of things, there will always be in that moment when you're there, when you invest for the first time, there will always be something that worries the market. There will never be a time where everyone's just happy and buying in. And if that even happens, if everyone is happy and there's no bad news, that's the actual time when you shouldn't be buying, because then obviously valuations get pushed upwards, the more money flows into those individual stocks. So hopefully this was helpful for you. Let me know in the comments what you think. Are you fearful? Are you still buying? I'm kind of, I'm still definitely buying. I'm not really fearful, because I've seen historic charts and I've seen a lot of stuff that's happening. So I'm still a buyer in this market, and let me know if you're one too, and see you next time.